Welcome back. It is time for the Word on Wall Street. Top investors watching your money. Joining me right now is Bell Point's Chief Strategist, David Nelson, and Bulltick Capital Markets Chief Strategist, Kathryn Rooney Vera. Great to see you guys this Monday morning. Thank you so much for being here. Kathryn, starting things off with you. We got the first read on fourth quarter GDP out on Thursday. The Federal Reserve's preferred read on inflation, PCE index out on Friday. And then there's this J.P. Morgan report. J.P. Morgan report reveals that the odds of a recession have dropped significantly from 2022 highs, Kathryn. We could have basically taken that away from my Jamie Dimon interview when he walked back his expectations of an economic hurricane. He said he should not have said hurricane. And now look at this new model that the firm is coming out with, that the odds of a recession are dropping rapidly. Do you agree?
So there's been a major swing from J.P. Morgan's very initially dovish, then very negative views back to dovish. And I think that's consistent, Maria, with the momentum in the marketplace. Year to date, cyclicals are up, defensives are down, and it's all because of this expectation of a soft landing. Why? Because disinflation is occurring while economic growth numbers remain resilient. The labor market is also remaining quite resilient. This is a lagging indicator. We have not seen the full impact of the more than 400 basis point Federal Reserve increases over the past 12 months. So I think it's premature to make this call. In fact, last week I published a piece saying the premature rotation into growth stocks, into small caps, into emerging market equities, into all of these lagging sectors that for sure will at some point see a mean reversion because they were the worst performing asset classes last year. It's too early to make that call. So yes, It does seem that the recession that is, I think, impending perhaps is not going to be catastrophic, but it's coming. And I do think that the Fed is focused on the labor market. And, you know, there's some people that say the labor market doesn't matter. You know, Claudia Saum, who is in charge of the Saum rule, saying labor market doesn't. And this time may, in fact, be different, but I wouldn't bank on it. I'm still recommending to my clients defensive positioning and have on your Santa Claus list all of those beautiful cyclicals that have underperformed so massively. But it's too early to jump into them yet. I do think recession is coming. I do think the Fed is pointing to an unemployment rate that has to go a lot higher. And that's going to take a bite on consumption and on earnings growth for this year.
Kathryn, what are your thoughts on that in terms of efficiently? Companies right now are trying to take expenses out of the business. We saw that in the banking sector in the earnings period, the beginning of this earnings period. We'll probably keep hearing that as, you know, corporates have to have a plan in place regardless of what models say what on a recession.
That's right. And this is part of creative destruction. So certainly AI will cut jobs, but efficiency will improve it. Hopefully that's the case, Maria, because when you look at productivity is lacking quite a bit. And that's the reason why I think inflation is so nasty and growth is so poor. Look, you have unit labor costs still rising and productivity, which is dismal. So that has to change. And I do think I agree that corporate earnings this year are likely to be revised lower. I think expectations are still, 7% positive for the year on year. I do expect that to come down and even come below zero, so negative earnings for 2023. Consistent with my review, Maria, that economic growth for the year is going to come out negative for 2023 versus 2022 to the tune of minus 0.4%.
All right, we will leave it there, and we'll be watching, of course. Have you back soon. Kathryn, great to see you. Kathryn Rooney Vera joining us. David, you're with us all morning. Thanks very much for that.